Because hidden costs cannot be precisely known in advance, some methodical estimates have to be used to take them into account. The procedure for many unknown hidden costs is to set up a loss reserve. This reserve is carried as an expense during each period, offset by a reduction in an asset's book value. For example, a bad debt reserve is established to record bad debts on a regular basis, even though this will not occur until sometime in the future. The purpose of the reserve is to record an expense in each reporting period rather than all at once. The accounting theory behind the reserve method is that expenses occur over time, and matters like writing off bad debts should not be reported only in the year when a company realizes that a debt has become uncollectible. So the reserve is created to recognize a portion of future bad debts each year. The principle of recognition is a reference to the accounting period in which an expense is recorded. A bad debt is recorded by reducing the current asset accounts receivable by the reserve amount offset by a current year expense. For example, if a company writes off $1,500 per quarter for bad debts, the quarterly entry looks like this. In the assets section of the balance sheet, the bad debt reserve reduces the value of the accounts receivable account. If a company has been putting aside a reserve of $1,500 per quarter for the past 5 quarters and current accounts receivable are $455,000, the status of these accounts looks like this. The company has recognized $1,500 each quarter rather than having a future bad debts expense hit the books all at once. This makes the reporting more orderly and consistent. For example, if the company writes off a bad debt of $6,200 at this point, the write-offs goes against the reserve, not against the expense that has been accumulated during the preceding 5 quarters. The level of bad debts is determined by historical levels. If a company experiences 1.5% bad debts on average, the reserve should be set at that level to anticipate that the trend will continue. As actual bad debts come in higher or lower than the historical level, the reserve should be adjusted. This summarized version of how hidden costs are estimated and placed into the books is only one way they can be managed. No one likes surprises, and managers are no exception. You wouldn't want to have to explain to your boss why your current quarter's profits were unexpectedly reduced by $6,000 because no bad debt reserve had been established. A similar approach can be used to set up reserves for any number of expenses. In companies with a lot of high maintenance machinery, a deferred maintenance reserve can be set up to anticipate expensive periodic repairs or replacements. If machinery typically needs to be overhauled every 4 years, it makes sense to set up a current reserve to book the known future expense every quarter. Equipment may also become obsolete as new models are developed and placed on the market. However, an obsolescence reserve is not normally required because this is assumed to be a part of the depreciation system, which allows the expense deduction of a specified amount per year, based on the method allowed and used. Depreciation is the spreading of the expense of capital assets over several years, and the resulting tax benefits of writing off the expense is also spread over the same period of writing off the asset. Capital assets are booked onto the balance sheet and then depreciated over what is called the recovery period. This is a reference to the write-off of the cost of buying and holding capital assets. Over the recovery period, the value of the asset is gradually set up as an expense and the purchase basis of the asset is reduced. We will see this in the section 7. So a depreciation system serves 2 purposes. First, it sets up a reserve for obsolescence, and second, it provides the method for converting the asset to expense over several accounting periods. The rationale for this is the same as that for setting up a bad debt reserve. Writing off the entire cost of buying new equipment as an expense would distort this year's operating results. By definition, a capital asset lasts for several years, so it is depreciated over a period of time estimated to represent the so-called useful life of the asset. This is not always realistic. For example, in the case of real estate, a purchase has to be placed on the books at the actual purchase price and then depreciated over many years. Two factors distort this procedure. First, land cannot be depreciated, so its value remains unchanged for the entire time your company owns it. Second, the book value of real estate declines each year as depreciation is recorded, even when the market value of real estate rises. The accounting convention does not allow a company to adjust the net book value, purchase price minus depreciation, to reflect its current value. So these adjustments have to be reported in footnotes. The net book value does not always reflect the reality. Real estate may be worth much more, and some other assets, notably vehicles, might be worth much less. It all depends on how value actually changes in the market compared to a pre-established depreciation schedule. Here is an example. Your company has two assets that are valued improperly. Many years ago, the company purchased its head office building for $2.6 million. Today, the book value is approximately $1.9 million, net of depreciation. However, the company recently refinanced its mortgage, and the latest appraisal concluded that the property is now worth $4 million. The second asset is a truck purchased for $28,000. Net book value today is $16,000, but because the newest models provide greater fuel efficiency and lower maintenance engines, the true market value of the truck is estimated at only $2,000. The adjustments between net book values and market values are shown here. The vehicle's disparity is quite small compared to the real estate properties change between net book value and market value. This is a common problem caused by the accounting restriction and the unyielding rule that an asset's acquisition value minus depreciation must be the reported book value of that asset. These kinds of disparities in how assets are valued can lead to problems for companies. In the 1980s, when leveraged buyouts were popular, some companies were taken over for a price above book value but below their true market value. If management is not aware of the market value of its capital assets, then the entire financial reporting system can deceive rather than enlighten any analyst. Hidden costs can involve many other sections of a company's financial report beyond such apparent and visible ones like bad debt reserves or accumulated depreciation. A reserve to cover uninsured losses might be needed in a company vulnerable to litigation but lacking complete insurance coverage. The interest expense of long-term financing without a contractual fixed interest rate poses another form of potential future loss. Inadequate cash flow represents a lost opportunity risk because the company will not be able to act if and when expansion opportunities or mergers and acquisitions become possible. Without cash, many opportunities have to be passed up without taking action. So hidden costs come in many forms, and a realistic approach to long-term planning requires the identification of those costs and, when possible, either setting up reserves or changing the current operating model to reduce or eliminate the problem. Some small companies, for example, have eliminated the expense of chronic bad debts by simply refusing to extend credit to customers. They require all bills to be paid at the time goods or services are delivered. This move is not always practical and invariably leads to the loss of some business. However, if bad debts have impacted profits to the extent that extending credit is no longer affordable, the loss of business becomes more acceptable than growing losses each year. The combined negative impact on profits and cash flow makes decisions like this unavoidable.